Welcome back to class. Today we'll be talking about taxation and financial compliance. And when we talk about taxation and financial compliance, some people may be thinking, why is that coming in law? Yes, it is very important because every of these things are interwoven, and that is why we'll be able to look at the critical pillars of corporate governance and business law, which is taxation and financial compliance. Also, as we look into that we look at corporate tax obligation, um, the value-added tax and good and services tax. We look at the international tax treaty and financial uh, audits, uh, essential for minimizing legal risk and optimizing financial strategy in today's global economy. This we will look into one after the other. And what is taxation? Taxation is a process by which governments collect financial contributions from businesses and individuals to fund public services and infrastructure. This includes the corporate income tax, the value-added tax, goods and services tax, and the payroll tax. And while we give the definition of financial compliance, it involves adhering to statutory requirements for reporting, auditing, and disclosure. And this includes timely tax return, proper accounting, audit standard, and anti-money laundering law. The corporate tax obligation uh, refers to the legal duty imposed on companies to access, declare, and remit taxes on their profits to government authority. So it's actually a legal duty imposed on them. And when this is on, the reason for this is to be able to access, declare, and remit taxes on the profit that have been made from the transactions performed to the government authority. And this ensures fair contribution to public revenue and influences a company's reputation and legal standing. So corporate tax is a direct tax on profits, funding public goods, and promoting investment. In the aspect of filing requirements, it's actually companies must file timely and accurate income tax return, declaring financial position, the revenue, the expenses, the profit, and the tax liability. For example, the example include of filing such a tax include that of we have that of USA, the IRS form, and as you can see there, we have T2 for Canada, and we have CT 600 for UK, and more as such. And for the periodic return, many jurisdiction mandates periodic returns, such as quarterly estimated tax payments to ensure continuous revenue flow and prevent deferral of large payments. So non-compliance leads to penalty, fine, and potential criminal liability. So there is a period which the return must be filed by such organization or um, complaint to the government, and failure to do that will lead to penalties, fine, or potential criminal liabilities. There are rates that each of these, whether country or whichever, uses. So just like we are saying, there are corporate rates, tax rates that are being used. The corporate tax rate define the proportion of a company taxable income paid to the government, reflecting the national goal like investment, promotion, or small business growth. Corporate tax structure can be flat or tiered, varying by country and sector. Um, what when we talk about flat, we have two structures of corporate tax, two structures. The first is the flat, and the other one is the progressive tax structure. And for the flat tax, that's a single uniform percentage on all profit that this is actually used, for example, by the United Arab Emirates. And for progressive tax, this rate increases as taxable income rises. And the likes of for Nigeria now, we have 0% for small scale, then 20% for medium, we have 30% for large companies. And there are special tax regime, and this is an exemption or reduction in the rate for non-profit sector-specific rule for oil and gas, incentive for export-oriented units in free trade zone, and scrutiny for multinational corporation to prevent base erosion. The advanced tax payment and withholding obligation. Government uses advanced tax payment and withholding obligation to ensure timely and efficient tax collection, maintaining steady revenue stream and minimizing non-compliance. And for the payments of tax in advance, it's the payment of income tax in instrumental based, installment rather, based on projected um, profits before year end. And this spreads out tax obligation using cash flow. And for example, like India using 4 installments, USA doing that quarterly, and Canada doing that monthly or quarterly. And for withholding obligation, corporation deducts tax at the source when making specific payments like dividend, interest, royalties, payments to non-residents, and this secure revenue, especially for non-residents, reducing base erosion. And just like we said, the rates vary by jurisdiction and treaties. We have the record keeping penalties and VAT, value added tax. Accurate record keeping is fundamental to tax compliance and supporting tax filing and protecting companies during audits. And a failure to comply with tax obligations carries significant um, consequences. And the standard for keeping, for the standard of record keeping, companies must maintain books, financial statement, the payroll record, and tax receipt for 5 to 10 years. And digitalization requires electronic submission of these records, and the consequences of non-compliance, as we've been saying, is monetary fine, interest, license revocation, public blacklisting, and criminal prosecution for evasion. And directors may face personal liability. Then that of VAT and goods and services tax, indirect taxes on goods and services levied. This is actually indirect tax levied on goods and services at each supply chain stage, with the burden on the end consumer. Businesses collect and remit deductions. uh, I'll take that again. Businesses collect and remit, deducting input tax credits, and compliance requires timely registration and filing. Globally, there are tax system, and taxation system vary across jurisdiction, reflecting diverse economic goal and regulators' philosophy. And for United Arab Emirates, it has 9% corporate tax as at 2023, and then 5% VAT and no personal income tax. For Nigeria, it is multi-layered system whereby 30% is for um, the income tax, the corporate income tax for large companies, and 7.5% is for VAT. And for United States, 25% corporation tax, 20% VAT, and strong personal income tax. Also for USA, 21% federal corporate tax, state or local sales tax also, and no federal VAT or goods and services tax. For European Union, the VAT is between 17 to 27%, and the corporate tax is between 10 to 35%. And uh, for Australia, 30% corporate tax for large businesses, and 10% goods and service tax, which also have a robust audit system. And lastly, for Canada, it's 15% federal corporate tax, 5% goods and services tax, and provincial sales tax also is being used. We have double taxation, and double taxation occur when the same income is taxed in two or more countries, increasing the tax burden on international businesses. And this can be in two types: the jurisdictional or legal double taxation, where two countries claim tax rights on the same income source. And we have the economic double taxation, which happens when the same income is taxed in the hand of different taxpayers, such as the parents and its subsidiaries. And for double tax avoidance agreements, there is an agreement that ensures the avoidance of double taxation, and this is to mitigate double taxation. Many countries have signed double taxation avoidance agreements or tax treaty that outlines which country has the primary right to tax a specific type of income. And tax treaty usually include provision for tax credits, exemptions, or reduced withholding rates, and they promote cross-border trade and investment. We need to talk also about financial audit when we talk about taxation also. And financial audit and statutory filing are key components of corporate transparency, regulatory compliance, and good governance, and they involve the systematic review and reporting of a company's financial activity by the internal or external professionals to ensure the accuracy and completeness of financial statements, as well as compliance with the national legal requirements. And for financial audits verifies financial statements and internal control mandates for medium and large scale complaints. And the purpose of audits is actually to verify the truth and fairness of the financial statements, to access internal control system, and to detect fraud, misstatements, and non-compliance with law. There will be others too, but we are limiting the purposes to this. Also, the double taxation avoidance. Complaints are also required to submit. This is an error. That's the statutory filing. That's a statutory filing. And complaints are also required to submit various periodic filing with tax authorities, complaints registrars, and regulators, which include annual returns or confirmation statements, a financial statement, and balance sheet, the tax return, which is the corporate income tax, VAT, and others, and also report on beneficial ownership and corporate structures. And failure to do that has its penalty and sanctions. And in conclusion, taxation and financial compliance are fundamental aspects of corporate governance, ensuring business operates within a legal framework while fulfilling their fiscal responsibility. On having this understanding, is crucial for business to minimize legal risk, optimize tax efficiency, and maintain regulatory compliance in an increasingly complex global economy. We will see in the next class. Thank you.